if you have the desire to sell your real estate for whatever reason, life happens in the world. So either do 1031 exchange or do QOZ to reduce your tax liability.
Thank you so much for tuning in to Journey with Christian D. Evans podcast. I'm your host, as always, Christian D. Evans. And guys, we have a very special guest on today. This guy's investment thesis and strategies are focusing on your income and growth, low correlation to public markets, and recession resilience. Do you think this would be very valuable information for you to listen to? You bet. His wealth management firm has almost $200 million assets under management, 21 current investments, 170 plus clients in the high net worth, ultra high net worth ecosystem. Their main focus are in alternative investing, such as, but not including, not limited to, infrastructure, secondary equities, private lending, mobile home parks, self-storage units. We're going to be unpacking a lot of this today, and that's one of the reasons why you need to make sure you share this with a friend, a colleague, someone that obviously wants to get into this, because him and I, we're going to talk about how the alternative investing space has outpaced the public markets by a very large margin, and that's the reason why we had this guest on. He is the founder and managing partner at Accretive Wealth, my friend Faraz Sattar. How are you today, Faraz?
Hey, Christian, thank you so much for having me over. I'm really excited to share some of the insights that we've been professing for the last 10 years. So looking forward to our discussion today.
Well, Faraz, I'm really excited about this as well. And what's interesting about this is, like I mentioned, you focus mainly on high net worth and ultra high net worth. Your firm, you were founded in 2012. And that was like, many years ago now. And you guys really just mainly focus on the alternative investing thesis. Now, you have an incredible ecosystem or background in the investing world, working with Contango Capital Advisors, Montgomery Asset Management, and so forth and so on. So why, let me ask you, in your journey, evolution of this, what was your focus point in just focusing on alternative investing? What did you see that you were on the forefront of now that we're seeing kind of the results of the results of the alternative investing space?
Wow, great question, Christian. So, I come from an equity background, buy side equity. I was a equity analyst at Montgomery Asset Management. So, what I knew about investing was investing in equities. Then I went to a wealth management firm, and over the course of 8 years there, I ran the company with my CEO. I became a CFO. And then the Bay Area bug kind of climbed into me, which was that, hey, become your own entrepreneur. So I left that firm and started my own wealth management firm, Accretive Wealth Management. And as I got into investing for our high net worth and ultra high net worth clients, I was looking out for, hey, what are some of the ways that other managers, other high net worth individuals are doing? What are billionaires doing? So I was very inquisitive in knowing that, hey, billionaires cannot be just investing in the equity markets. There's got to be other sources of assets that they're investing in. That's the cause of their part of the cause of their rise in their net worth. And upon doing that, I came into a couple of unique investments. And as I dug into them, their investments, and I especially looked at Warren Buffett. Buffett owns a company called Clayton Enterprise, and that makes manufactured homes. So then I looked into manufactured housing communities, and I realized that's a cash cow. I through my research, I found a company that a fund that invests solely in manufactured housing community and self-storage units. So I went and spoke to the a person, the managing partner of that firm. I went and met him, went through his financials, went through his investment model, and realized that over the course of the last 20 years, on an average, he's given close to 14% average annualized return, which was totally non-correlated to the equity markets. On the contrary, it was recession resilient manufactured housing communities. So that sparked my interest in saying that, hey, that is a unique way of making money, which is not very market driven. And luckily, I had a family friend who was in this business as well. So I reached out to him and I told him that, hey, this is what I'm finding out about this industry and the margins and the return profile. And he said they're all true. So I was like, my first thing was that, hey, if it's true, let me invest with you. You already own 7 manufactured housing communities. And he said he didn't want any outside capital. He's happy doing his own thing and making tons of money for himself. So then I partnered with this company in Colorado, and started investing in manufactured housing community for our clients. As I reached out to my clients and I shared the idea of, hey, how it's income and growth, low correlation to public markets, and recession resilient, clients found it very unique and were very interested in investing in this kind of opportunity. So that kind of sparked the growth of our clients and our firm to start looking in alternative investments and private investments. So that was the private real estate. As you know, as you path your chart towards a certain industry, then you go deeper in it and you'll find various opportunities to invest. And that was the crux of our firm, investing in private investments for our clients. And as we found more additional investment in private debt and private equity and others, clients were mostly interested in looking at these opportunities, and that made us very heavily involved with private investments, such that we are now only investing in private investments, private equity, private real estate, private debt, hedge funds, and qualified opportunity zones for our clients. And that's the genesis of how we started into this space.
Well, Faraz, what I love what you said is you really stepped back and said, okay, where are the billionaires investing? You know, because they're not investing into the equities. Not only, right? That's maybe one of their strategies, but the other strategies are also in this alternative investing. I think that's what was so interesting. Now, you also your Accretive Wealth really focuses on a lot of different kind of strategies. Was it an evolution of adding each vertical to your firm, or did you guys focus on maybe one or two kind of strategies first, and then you started adding the other verticals as well? What did that evolution look like?
So if you look at the public markets, right? You start with some 20 years ago, you had some 8,000 public equities available to invest. Now there are roughly about half of that, roughly about 4,400 public equities for us to invest. If you look at the returns in the public markets, the 80% of the returns have come from 7, 8 stocks, even on the S&P side or on the NASDAQ side or on the Dow Jones Industrial Average side. So you ask yourself that, hey, if I'm not in those 7, 8 stocks, I'm going to get the market return. Then why are investors coming to advisors like us? They can go buy those same 7, 8 stocks. So that was also another reason why we felt that, hey, we need to find opportunities outside the box to help our clients diversify and grow their assets. So with that mindset, with the invest like a billionaire mindset, we started with real estate, and we found a couple of private debt managers that were paying us 8.5% income in a diversified fashion, first lien, senior secured, floating rate loans. And at a time, by the way, when the interest rates were close to zero, and treasuries were yielding less than 1%, investment grade bonds were yielding less than 2% or around 2%. And here are some of the other private debt managers that are paying 8.5% income. So the disparity, I mean, the difference, the delta between that was so enormous that you were willing to take some illiquidity, which was quarterly illiquidity rather than daily liquidity in these bonds. So that made very interesting investment opportunities. And these were with large firms, right? We look talking about Blackstone, we're talking about KKR, and others. GSO Blackstone being one of them. So that helped us move into private debt and opportunities. Then, as we looked around and did a lot more research, we found there's some investment opportunities in the private equity side where the middle market of our industry is severely underserved, and there are some unique companies that have a phenomenal track record and a historical perspective, like 30-year view on it. And those guys have done exceptionally well. So we started looking at some of those investment opportunities and found that, hey, these are legit companies with phenomenal track record in the last almost 30 plus years, and institutional client base. But this is the first time they're coming in the private investment space. And as luck would have it, we started investing with these managers, these kind of managers, and we've done exceptionally well. Totally non-correlated investment. In 2020, we went up. In 2022, markets were down big time. We were up almost 9% in those kind of funds. So, living up to our standards of income and growth, low correlationship to the public markets, and recession resilience.
Let me ask you this because, within the last really 10, 11 years, um, we have seen that, original kind of 60-40 split of a regular, portfolio has really
Hmm.
adjusted. And the reason
Hmm.
why I really wanted to have you on for us is just because, like you mentioned, we're seeing taxation, we're seeing inflation, we're seeing even the fees of some of these instruments, these vehicles, they really get eaten
Hmm.
up. And so, like, net, a lot of these individuals, Main Street, even high net worth or ultra high net worth, you really got to be aware of what is the interest rate. We really got to make sure that we're outperforming everything, because really at the end of the day, it's, you're netting maybe 3 or 4% actually, right? If you look at it holistically a little bit. I want to ask you, Faraz, real quick before we continue, the importance of having this conversation with, for our listeners, having this conversation about alternative investing, right? Some individuals are stuck with that 60-40 because some wealth
Hmm.
managers may or may not be very familiar with the
Hmm.
alternative investing like you are and your team, and Accretive Wealth. But also, I think it just be, and that's one of the reasons I want to highlight this incredible vehicle. And there's different, with even within this vehicle, there's tons of different verticals, which we're going to be diving into a little bit further as well. But just explaining the importance of it, and maybe just making sure that that's a highlight or top of mind for our audience.
Yeah, so all the numbers so far that I've shared, again, past performance is no guarantee for future returns. Let's be very honest about that. But all the returns that I'm sharing are net of fees from the managers. So, this fund in the private equity fund that I'm talking about, their return last year was 9%, was net of their fees. And not just 9% return last year, but over the last almost 5 years, the returns like 10.5, 11% net of their fees. So yes, the thought is that private equity has a little higher fees than the conventional assets, but they are more diversified. They're more their net returns are substantially historically higher than the public market return, in spite the fact that in the last decade, the stock market had a unconventional return of in the tune of like 12, 13%. In spite of all of that, private equity in the last 10 years, on an average, has yielded almost a 20% return. So the delta between private equity and private public equities has historically been 5 to 8% average annualized disparity, and it's significantly enhanced in down markets, because in down markets, by and large, these investments hold their value very well. Although, yes, these larger firms, their signature funds will mark to market to the markets, and but these are just marking it to current numbers. current positions, they're not losing any money. And these returns have been phenomenal. Not just returns, Christian, your point being 60/40, there are a lot of managers who are now talking that possibly 60/40 is dead. The return in 60/40, the expected return, JP Morgan has an enormous report out on it. The average return that they expect in 60/40 in this decade is like 4.5% in this decade. So if you're seeking a 60/40 return allocation, and you expect, let's say, anywhere between 4 to 5% average annualized return, and you find with it, then 60/40 is the way to stay for you. But if you're seeking for more diversification, less disparity and higher returns, although it'll be a little illiquid, but most of these firms, JP Morgan, Carlyle, Apollo, Goldman Sachs, all of them are suggesting that there needs to be a higher allocation to private equities in the for individuals. As we've seen historically, these institutional clients have already done that in the last 30 decades. Sorry, 3 decades. In the last 3 decades, endowments, institutional investment firms, and others have substantially increased their allocation to private markets and reduced their allocation to public markets. And Yale being one of the great examples of that. Yale was among the first institutional manager that substantially increased their allocation to private investments to over like Yale had a commitment to almost 70% of their portfolio was non publicly traded investments. So they reduced their exposure to bonds, they reduced their exposure to equities, and they went heavily into private investments. And Yale is used as a headline on alternative investments because their returns were substantially higher than most of the other endowments and other institutional investors. So, not saying that 60/40 is not perfect for everyone. For some clients, a 60/40 portfolio works because they got enough net worth that if they get a 4 5% return net of fees, let's say call it a 4% return net of fees, they're fine with it. But for vast majority of us, we are seeking a little higher return than that, and in order to seek that kind of return, you have to look into private markets to get a higher return. Although the founder of Bridgewater would tell you that if you have 5 non-correlated private investments in your portfolio, the risk in your portfolio goes down by 50% because of the non-correlationship of these assets to your traditional 60/40 portfolio. So yes, individually, if you look at it, they are longer term, private investments are longer term, illiquid investments, but they reduce your overall risk in the portfolio and enhance and are expected to enhance the total return of your portfolio.
Yeah, and that's why I wanted to emphasize again, like having that conversation for that kind of, that portfolio, that 60/40, that's so kind of original. Now it's like you need an update. You need a massive, hey, this is the 21st century, guys. This is what we need to be focusing on, and saying you guys need to adjust this. Again, I can say that because, of course, I'm not, in the FINRA, SEC regulated, whatever. So I can say, hey, guys, this is a conversation you need to have with your wealth manager or Faraz and his team in regards to alternative investing because it is outpacing. And I found this very interesting. So I want to get clarification on what you just mentioned. So what you're basically saying is that by having 5 non-correlated assets, then that helps actually de-risk your portfolio. Is that correct? In the way I'm hearing that?
Yeah, yeah. And if you look at the founder of Bridgewater, Ray Dalio, if you listen to Ray Dalio, and Ray Dalio is somebody that I highly admire, he would say in his conversations several times that having 5 non-correlated private investments in your portfolio, it would reduce the overall risk of your portfolio, overall net worth risk by 50%, 50%, whether it's real estate, private debt, private equity, and things like that. The general consensus, the general view is that alternative investments are higher risk than traditional private public investments. And some of them, yes, of course they do, because the term is longer. But if you, there's something good BlackRock said to me once. You don't need 100% of your assets in liquid assets 100% of the time. And it kind of stuck with me because oftentimes you and I, and maybe not you and I, but vast majority of the people do think that, hey, I want to be liquid because what if I need the money? If your net worth's $5 million, $10 million, do you really need $5 million every single day? No, you don't. And those clients have direct access to other opportunities. If God forbid an emergency comes, you have other avenues of getting some liquidity. So if you take the liquidity risk out of these private investments and say that, hey, if my net worth's $5 million, can I not lock up a million or two for the next 5, 6, 7, 8, 9, 10 years and get a stable, higher return, expected higher return? I have to be careful. And the answer is absolutely, you should. Now, what is the mix of that kind of return? How much of income, how much of growth, how much of tax benefit that you want? That's an individual discussion. But on a overall basis, should we have a good percentage of our portfolio in illiquid, longer term, potentially higher return, lower volatility investment vehicle? The answer, I think, overwhelmingly is yes. And our clients are proving that because they're reducing their exposure to public markets and increasing their exposure to private investments.
This is incredible, incredible. And I'm so glad we walked that through because that is a huge, huge data point right there for a lot of our audience and for myself as well. I want to dive into this because ever since I sold my business, I have always been familiar somewhat with private equity as well as real estate. But I didn't realize, holistically, there's a lot of different strategies and a lot of different verticals in regards to alternative investing. And each one has its own thesis, its own objective. So I want to kind of emphasize a few things for us, and I want you to just take it from wherever you want to go with it. But like you mentioned, private equity a little bit, that is outpaces. Obviously, that's incredible. There's been a lot of metrics where it outpaces a lot of all the other alternative investing strategies. Real estate, we all are very familiar with. You can do depreciation, definitely if you do direct, which is incredible opportunity as well for taxes. And there's also opportunity zones. I don't think a lot of people, I was not very familiar with opportunity zones, even the opportunity like environment ecosystem. There's a lot of different verticals within that, which I found very interesting. And then also there's a lot of private lending and mortgage-backed loans, which then really create that nice passive income a little bit as well. So I just want to kind of maybe unpack when you have a new client on, like you mentioned, you got that thought process. It is very individualistic. Maybe kind of help us understand how Accretive Wealth takes that new client, what they're looking for, that conversation that they have. Maybe a case study. I know you can't share any names and numbers. That's perfectly fine. But maybe just certain stories that, like, hey, this is what was happening. This is their thesis. This is what we're able to put them in, and that's how we walk them through that. So if you could, that'd be awesome for us.
Sure, my pleasure. So, and I'll give you a thesis without naming the client, and hopefully that'll help as well. So, when a client comes in and has oftentimes referred to us, not often, always, we only get new clients from referrals from our existing clients or from friends and family, and we would sit down with them and talk about, hey, what do you have right now? What do you want? And where are you going? And how much risk are you willing to take during that time? And is there any income need? For younger clients, they don't need income. For older clients, they're seeking income because they're in their retirement. And what is your liquidity period? I think it's very important to understand what are your liabilities for the next 3, 5, 10, 15, 20 years? The younger clients have college tuition to pay for their children. They have wedding to pay for their children. They have desires to buy some luxury products. The older clients have one of the biggest thing that's on their mind for our clients is how can I reduce my tax liability? And two, how can I successfully transfer my wealth to my second and third generation? And of course, number three, how can I live comfortably on my wealth without depleting my wealth? I think that is key for, especially for older clients. And one of the biggest questions that we get asked from all of our clients is how can I reduce my tax liability legally, of course. And if you're a business owner, there are amazing opportunities via defined benefit plan that we can open for our clients to our pension administrators. And for our older clients or our clients who have a lot of capital gains, qualified opportunity zones, as you mentioned, is a great tool to use to reduce your tax liability. Then there are some insurance vehicles as well, and there's some others, but we don't sell any insurance. We will refer you to somebody if you have an insurance need, but we are strictly focused on investing for our clients. We've never wanted to diversify or dilute rather our view with the client. So I'll give you a view of a client, how I helped over the course of years grow their wealth. So I met a new client in 2013, end of 2013, and net worth was, let's say, at that time, close to $3 million. And he was very risk averse, wanted stable income and growth for his portfolio, came from 100% equity background. His portfolio was either his primary residence or equities. And his primary residence was at that time $1.5 million, and it was completely paid off. He had zero debt. So I convinced my client to take out $500,000 from his primary residence and go buy an investment property. So his equity in real estate will still be the same because he took out $500,000 from his home and he invested. But what he did was he diversified his equity within real estate. And that he took my advice and went and bought a 9 unit apartment complex. And of course, that was generating income, did very well for him. Then I asked him, refinance the property, take out some money from that, diversify some into private equity, private real estate, private debt, and go and buy another property. He did exactly that. As you know, in the last decade, real estate has done exceptionally well. His property value almost doubled at that time. He took out some equity and bought another property and increased his allocation to private investments. While he was doing that on the real estate side, he slowly transferred his equity position into private investments with us. And as years progressed, he refinanced the property, bought his third investment property, almost a 40-unit apartment complex now, and again diversified some into private investments, some into real estate. And now, with almost 10 years out, his net worth has more than tripled through that. Now, of course, he's been earning well as well, but the thought that in this environment, in a span of 10 years, he tripled his net worth through using some of the advice we gave, some of the investment vehicles we used for him, and so that is one way we've been able to help some of our clients that having said that, equities during that 10-year period did very well too. let's give that credit to the public markets, that equities grew during that time from 13 to now almost 10% average annualized return, which is very good for equities. But through private investment opportunities, through real estate investment opportunities, he was able to grow much faster. And not the volatility that we saw in 2018, 2020, 2016, the volatility in the public markets. He didn't face any of that in the public markets. So that is something that resonates with our clients, that hey, diversification into private markets and growing through real estate. And by the way, the benefit, and Christian, you mentioned it, the benefit of real estate, whether through a fund or through a direct real estate ownership, is it's a through depreciation you can reduce your tax liability by taking depreciation. The funds that in real estate that we've invested, they also take depreciation, and in direct real estate investment, you also take depreciation. Now, the by taking depreciation, I must add, the flip side is when you sell, you have depreciation recapture, and you have to now pay tax on that depreciated asset. But what our clients have done, and what we've advised our clients, is if you have the desire to sell your real estate for whatever reason, life happens in the world. So either do 1031 exchange or do QOZ to reduce your tax liability. But our view is that if your real estate's giving you cash flow, a decent cash flow, do not sell the property unless you really have to for some life-changing reasons. Because real estate is a great property, a great value of earning income and tax deferred income, and it helps growing your total asset value for your clients. And I've seen a lot of our clients benefit from this kind of strategy that we've been talking about.
What I find so interesting about this, and I want to get your kind of perspective on this. I have seen some individuals that scale, some of our audience are in this, where they scale one and all their eggs are in that one basket. And maybe they're starting to take, that business is starting to, scale to 7, 8 figures. Now they're starting to take some dividends. And that could be, decent size, right? 7-figure kind of dividends from their company, whatever it may be, payment, whatever, however they structure it. And now they're looking at, okay, how do I want to diversify it? And my thought process is, and this is kind of what I gravitated toward, was I'm going to invest in things that I'm already somewhat familiar with. One, because I'm already
Mhm.
somewhat familiar with that industry. However, though, I want to get your perspective, Faraz, because you look more strategically and holistically and say, hey, you may not be familiar with this asset class. However, though,
Mhm.
strategically, this is how this asset class can be beneficial for your circumstance. So, for example, in
Mhm.
that guy's circumstance, in his situation, he may not be familiar with the real estate industry, but he's like, hey, let's go ahead and refinance this and let's get into the real estate industry. And you gave him an asset class that maybe he wasn't too familiar with. So I wanted to get your perspective on that, because we have heard kind of different things and different strategies. And what is your thesis in that regard, in regards to like, hey, maybe I'm not familiar with this. And obviously I'm just saying real estate, but like private equity, I think people have heard of it, but they're not too familiar with it. How do I approach it? Have that conversation? Maybe even private lending, all those things that are a little bit more convoluted, maybe even natural resources, which I found very interesting asset class as well. So just those different ways, like, okay, I'm maybe not familiar with it. How should I approach that? And like you mentioned, it may be very strategically beneficial for my methodology or to generating wealth.
So I think the key here, Christian, is that you got to educate your client. And we take a lot of time and effort. And once a prospect is referred to us, we would educate them on what are we investing in. We don't just talk about, hey, income and growth, low correlationship, recession resilience. We talk about what are the attributes within these investments. How would you benefit from it? What are the risks in it? You got to identify the risk. What is the liquidity period for it? Are you comfortable? Is your net worth and you personally comfortable with this illiquidity? Because we're honest and sincere people. Because we honestly, my crux is that, hey, you got to be true to people, and if it's in their benefit, if I'm able to identify that that's their benefit and they find it beneficial, they'll invest with us. So it's not a selling. We're not a broker dealer that we are selling. We are an RIA, registered investment advisory firm. So we are fiduciary to our clients. So we always have to look out for what's in the best interest of the client rather than just make a commission and sell. We've never taken a dime of commission from anyone in the 10-year life of our firm. We've always, our fees are paid by our clients, not by our investment managers. They're not incentivizing us to invest. We're agnostic, on the contrary, agnostic whether you invest with Carlyle, whether you invest with Apollo, whether you invest with Goldman or BlackRock or CNL or Sealy or Shapa. We're totally agnostic to where you invest because our fees is flat wherever we invest. So the first and most important thing is, we all our clients who have come to us, 90 or 95% of them have never invested in private investments. So what we do is, we sit down with them, we educate them, we teach them about, hey, what are the elements of this? What are the risk profile of this? What is the growth element of this? Where is the growth coming from in their portfolio? Like, I'll give you a short example. We started looking at secondary private equities long before secondary private equity became very sexy and very favorable. And vast majority of our clients had heard of, hey, I can buy a pre-IPO company as a secondary in the secondary market. But that's a very small piece of the pie. That's just a few $1 billion. We're talking about institutional private equity, private real estate, private debt, hedge fund, institutional sale in the secondary market, which is worth, I think, a couple of $100 billion right now. So we find that piece of the private equity space very, very favorable to our clients for a few different reasons. One, that the private secondary market, let me start with this. Let me give you an example. Let's say an institutional investor has $1 billion portfolio with a large private equity company, and it's very common. Let's just use as an example BlackRock. Let's say an institutional manager has $1 billion portfolio in BlackRock. And because of their liquidity needs, the institutional manager and institutional client, because of their liquidity needs or their allocation mismatch, they have to, for some reason, liquidate $100 million of their private equity in BlackRock. So they'll go to a manager, large secondary institutional manager, and ask them, I got $1 billion private equity portfolio with BlackRock. These are the various funds that we've invested in. I have a need to liquidate $100 million. Would you be willing to buy this $100 million piece of my $1 billion private equity? The secondary manager would take a look at that portfolio, will talk to BlackRock. What are the underlying investments in it? What is the scope of growth in this portfolio? And if they like it, they'll say, yes, sure, I'm interested in buying this $100 million portfolio. But guess what? I'll buy it for $85 million or $90 million or $95 million. And right now, on an average, roughly about a 23% discount, which means they'll buy it for $77 million. So you bought a $100 million portfolio for $77 million. So you bought it at a 23% discount average right now. But this $100 million portfolio, the reason you bought, is expected to give you a good mid-teens, high teens kind of return. So all of a sudden, your return in that portfolio is mid-teens, plus you got a 23% discount. So now your returns are high teens, average annualized. So that's one benefit. The second benefit of secondaries, in our view, is most of the funds that the secondary managers are buying are in the 4th to 5th year of the life of the private equity fund. So your lifespan of the secondary fund is shorter, and they're buying the J curve in private equity. You've avoided the J curve in private equity. And you're investing at a time when the private equity company is starting to return money back to investors. So there are several benefits for investing in secondary private equity funds. Now, when a client comes to us, we'll educate the client that, hey, these are the benefits why you should consider investing in secondary private equity. The fund still might be a 10-year fund, but with vast majority of your money is going to come back much sooner than the buyout private equity fund or co-investment private equity fund or a distressed private equity fund. Okay? So the crux is, sorry, the crux is that you got to educate your client base and find out what are they looking for. Again, you got to put your fiduciary hat on and say what is in the best interest of the client. Now again, there is no guarantee for future return, right? There is an investment, there is no guarantee other than if you're putting in your money in an FDIC insured product for cash management, which is right now yielding almost 3.8, 3.9, right? But uh, you always expect a return from the manager. Sometimes you get it, sometimes you don't get it. So there's no guarantee of any return. But if you're with managers who are seasoned, who know how to take advantage of the opportunity and historically they've done well, then you expect a certain kind of return in a parameter. Again, if a manager expects a 17, 18% return, you get a 15% return, we can live with that. You get a 12% return. Some market variances might have happened and you got a lesser return, but the band is somewhat um, closer, then the variation is not that enormous with seasoned managers who have been doing it for decades now. So to answer your question, I would say educating the client is the crux of everything. Helping the client understand that, hey, what are the pros and cons of doing this investment in your portfolio? And one way, Christian, the way we educate our clients, of course, we do it one-on-one with a client and prospect. And it's, by the way, Christian, it's not a one and done kind of situation. We've invested with Hamilton Lane being one of the managers, right? Hamilton Lane is one of the large managers of secondary markets, and they started a somewhat liquid fund, quarterly liquid fund as well. And we had to now educate our clients that, hey, this is not the secondary fund that you used to investing with us with Hamilton Lane. This is a semi-liquid quarterly liquidity fund, but it has a few different elements in this fund. It's 40% secondaries, 40% co-investment, 20% private debt. So it's an entirely different risk profile. Your liquidity demand is different, your risk profile is different, your return profile is different. So you got to continuously educate your client and help your client understand the benefits of investing in this and the benefits of your overall portfolio. How does that fall under your overall portfolio needs and demands? And in educating one-on-one with a client, and then we do a seminar as well. So once a year we've been hosting a investment seminar on private investments for our clients, and then we invite all our investment managers, to come and present and educate our clients on what are the opportunities available in the private investment space with their risk and their return and their diversification requirements and benefits, pros and cons for each investment. So I think helping clients understand that is probably the crux of why clients want more and more in private investments.
Well, Faraz, I really appreciate you just unpacking that at a very deep level. And I get very pumped up about this kind of thesis. One, because we're seeing a massive up to the right trajectory in regards to private equity specifically. One, we saw the Jobs Act, but also the SEC guidelines are adjusting what accredited investor means, which means there's going to be more flow toward that. That's one of the reasons why I think it's going to be really important to have these conversations and this dialogue and say, hey, let's readjust this and say, for democratizing this private equity side of things a little bit. But also, I think it's really interesting because we're also seeing a lot more companies. I think you mentioned prior to our conversation or in our conversation here, there are less IPO companies now. Most of them are staying private a lot longer, which then
Mm-hmm.
also, like you just mentioned as well, these private equity funds, they are in their third, fourth, fifth one, which means obviously they're really able to scale in their streamlined systems and so forth and get like that IRR a lot better. And these companies are staying private. So it's just like a perfect storm is what I'm seeing holistically. And that's why I get really pumped up. And that's why I appreciate you kind of unpacking this, explaining to our audience, one, the strategy, but also for us, I just want to emphasize one thing for our audience. For those that are not familiar with an RIA, registered investment advisor, you
Investment
guys
advisor.
just your guys' focus really is not to sell products. Your guys' focus is to
Mm-hmm.
look at that client's thesis and say, okay, what's your objective? And then suggest them certain things that will be most beneficial to achieve those goals and those results. And that's why I think it's really, really good because, like you mentioned, it is that client's interest at heart. And so, like you mentioned, it is to educate them. So, hey, they may not be familiar with private equity, saying, hey, this is going to be actually very beneficial, and explain why that is for that client. And, again, we just mentioned private equity specifically because it does outpace, the rate of return tremendously. I want to talk a little bit further into this. We mentioned some of these markets are illiquid, right? They're not as
Mm-hmm.
liquid. And we're talking maybe 2, 3, 4, 5, sometimes 7 years. I've seen some definitely in the impact investing kind of focus a little bit. So, your money's tied up in that. And of course, you can always deploy more. How do you guys look at that strategically when you're having that conversation or that dialogue? Do you say, okay, well, you know, it kind of really just basic fundamentals. What's your expenses? What's your monthly, result? What do you guys want to achieve? And then, okay, well, if you get a, $2, $3 million, cool. Or do you have like, let's deploy X amount of dollars over a period of time that hit that kind of threshold of that goal of, deploying $5, $7 million. I'm just curious, how do you guys look at it? Because, having that conversation illiquid, 5, 7 years, that's a long time. In essence, having something held up for a little while.
And some of these funds have a 10-year lifespan. Like one of the conventional private equity funds, the buyouts and the co-investments, they have a 10-year lifespan of the fund. So I think the crux is on this, Christian, is you have to know your client. What are their needs? What are they looking for? Are they looking to stay liquid? Are they looking to stay are they seeking long-term growth? Are they seeking lower volatility? Are they seeking higher income? Are they interested in looking at an overall portfolio which reduces risk? Or are they looking for all of that? There are clients who are seeking all of that. So I think in knowing your client and understanding what they are looking for from their wealth is very important. Understanding their liability stream, is very, very key because, you can't have a client locked up for 10 years when they're telling you, hey, I need this money for whatever reason in 3 to 4 years. Then you're not doing justice to your client. It's not fiduciary that, hey, if a client has a need for, let's say, $1 million in 3 years, and you've locked up that $1 million for 10 years, then you did not do justice to the client. So we have to accommodate what are the needs of the client, what are the tax consequences of this investment to the client himself or herself in that scenario. So I think it's very important to have an understanding and have a very, very open discussion with the client as to, hey, what are you looking for in your investment? Are you looking? So I'll give you an example. Some of our clients in their 40s and in their 50s are seeking long-term growth. Not some, I'd say most of our clients in their 30s, 40s, and 50s are seeking long-term growth. They can easily be locked up for 10 years. Their lifespan accommodates and values that. Our clients in their 70s are seeking shorter illiquidity, higher income, and I'm generalizing it, of course, within that category. Of course, there are clients who can go in any side of the aisle, but they're looking for investments which are giving them income today. So for those clients in their 70s, if I put investment which is a 10-year investment and they're only going to benefit 10 years from now or 7 years from now, that's not a good use of their dollars in our view. Okay, you got to cater to what the client has the need for. So for them, we are more on the shorter end of the liquidity side while seeking the income profile that they're looking for or the growth profile that they're looking for. Now, within that age category, there are clients who have enough wealth that they know they're never going to consume it and their children are never going to consume it. We have clients like that as well. So for them, we are more strategically longer term in growth and such. For our younger clients in their 30s, 40s, and 50s, and they're high earners and they have a good amount of wealth created already. For them, the growth investments are very good because they have a longer term time horizon, but also the fact that those growth or high growth private equity or some other funds, even on the private debt side, on the distressed debt side, or on the opportunistic debt side, those funds are capital call funds. So if they're committing $1 million to this capital call fund investment, the $1 million is not paid out today. It's paid over the course of 4 years. And they're fine committing that because one, they'll earn that much money over the course of 4 years, or they'll have enough money available in the next 4 years, but they want to commit to today to investing $1 million in that kind of opportunity. And that is where, again, it all boils down to educating your client that, hey, what are the pros and cons of each investment, where the value is, where the opportunity is. Why should a 35-year-old client be locked up for 10 years? Do they have enough liquidity if, God forbid, something happens in their life? Do they have other source of income that if I am suggesting them to lock up this money for 10 years, do they have other source of income that, hey, if they, God forbid, have an emergency, they have access to that kind of wealth and money? So understanding that and then guiding your clients through is, I think, I'd say one of the that's our responsibility as a fiduciary. But apart from that, that is what when you perform that way, clients stay with you. Our view has never been that, hey, let me just make a quick buck. Our view has always been help the client over the course of years, and they'll be your client for life. And I can proudly say that, hey, our clients have stuck. Our attrition is very, very low, and our clients have stuck with us for a much longer period than most of the financial advisory firms. And the reason for that is because we look out and have that educated discussion with our clients, which helps them understand these investments and then move forward.
Yeah, and what is so interesting about this, it is putting a puzzle together. And as I've come to understand, I don't know what I don't know, right? And I think that's what I want to emphasize with our audience is like if you guys maybe are first time hearing this, or maybe it's your second or third time, but you've not like really educated or learned about this, you need to probably reach out to Faraz and his team and ask those questions, and they'll be able to walk you through, look at your picture holistically, and put the puzzle together to identify which vehicles will be the best for your situation. I had a friend of mine just recently when his business exploded within the last 18 months. Now he was with $20 million tax bill, and he started talking to his wealth managers and tax strategists and trying to identify. And the only solution that they could come up with is go to Puerto Rico. And then he started talking to another tax strategist, and she was mentioning all sorts of different other vehicles that they were not very familiar with or even aware of. And so my point is find people like Faraz that are able to say, okay, we're heart surgeons, right? We're very good at what we do, and we're able to identify what situation you're in, and then be able to create the puzzle and put the puzzle pieces together. So Faraz, I really appreciate you just sharing your incredible wisdom and your knowledge today and your experience, expertise on our podcast, definitely with our audience as well, talking about all these different verticals that a lot of our audience are not familiar with. We're seeing this massive money transfer of wealth directly into these ecosystems, and being able to just touch on that just a brief little bit. Obviously we could go into a lot more detail in each one of those verticals, but for those that want to reach out to you, maybe have some more questions, that want to engage, and you have tons of resources, how do they reach out to you, Faraz?
Thank you so much, Kristen. And it'll be our pleasure to kind of have this initial discussion with whoever might be interested in it. You can reach out to me on our email, Faraz at accretivewealth.com, or you can reach out on my phone number, 925-699-8563, and go visit us on our website. We're very transparent on our website, which is accretivewealth.com. And just to identify, the private markets right now is roughly about $13 trillion. In the next 5 years, actually 4+ years, by the end of 2027, Preqin, which is a industry data collector, and they forecast the growth of the industry. They have projected that by 2027, the private markets would go to close to $24 trillion. So almost a $9 trillion increase in the span of from $14 trillion to $23 trillion. $9 trillion increase, which is a greater than 60% growth in the next 4 years. That's how the private markets are expected to grow in the next almost a decade.
Huge amount of upside. And Faraz, I really appreciate making yourself so available, your email as well as your phone number, as well as I put his website down there, Accretive Wealth. So make sure you guys stop what you're doing and reach out, because I know you guys have questions. I know you guys probably have resources that you want to consume. Accretivewealth.com, all of his content down there below. Faraz, again, I really appreciate being on here. I always love to ask my guests, is there any last words of wisdom they'd like to share with our audience before we let you go?
No, what I would say that, look for outside of the norm that you're doing. I think this coming decade, the returns are not going to come from the same investment opportunities that you used last decade. If you look at the historical 40, 50-year time horizon, you'll realize that every decade, the return comes from different sources. And it's not the same thing. Infrastructure, and I'm happy to have another conversation with you, Chris, on infrastructure. I think there's phenomenal opportunities in infrastructure, but staying within private equity, private real estate, private debt, some tax savings through QOZ, meaning explore those options. Talk to people who may have some knowledge of that, and by exploring, you're not going to waste a lot of your time, because I'm absolutely certain that you will find some opportunities in diversifying your portfolio in this next coming decade, where the returns not all going to come from equities.
Well said, guys. And I want to foot stop on that big time, guys. That is the founder and managing partner of Accretive Wealth, my friend Faraz Sattar. Guys, that is Journey with Christian Davis podcast. Until next time, be uncommon if you can.